Why you should scale into trades. Hi, it's Charlie giving you Saturday's video. So I'm going to use this chart of gold here. It's quite a timely chart going on here with gold breaking up there yesterday. So there are various reasons to scale into trades, but I'm going to talk about two. One is building positions. So you get into a trade and then you add to the trade as it goes in your favor. And then so you start to accumulate more position as the trade goes in your favor. The other one, which people don't consider as much as far as scaling into trades or edging into trades is concerned, is what I'm going to talk about here today. So we've got gold. Gold's breaking up. So okay, you could be buying gold up here as it's breaking these highs, and I have no issues with that. But there is something else you could do. So, for example, gold for us was giving some signals back down here as a buy. So, but of course, at that point in time, if I actually take this into real time, so if I put it into replay mode, down there, yes, it was giving some buy signals at that stage. Some of our members were getting in around then. But of course, the context of the market at that stage was that gold had been chopping sideways for 2 or 3 months already at that stage. And so it was uncertain as to, it's not completely clear at that stage as, oh yeah, it's definitely going to go up, even though it gradually started to go and then it's pulled back and then eventually started to break here. So one thing that I think a lot of traders forget that they can do is, when I say scaling into trades, using that example there, or even over here, when gold started breaking up about a week ago, is put a smaller position in earlier on. So you don't have to put your full size position in. And I think a lot of people forget that. And so they're always trying to make a decision around putting their full size position in. Whereas actually you can scale in or dip your toe in the water, as I use the phrase, and say, well, okay, I'll dip my toe in the water down here. Or if you weren't going in over there and you're going in even over here, it's still, the context is still choppy overall, but you've got a signal on the daily charts or whatever over here. Well, I'll tell you what, I'll dip my toe in the water with a smaller risk position. So for argument's sake, if you normally risk 1%, maybe you put 1/3% as a position size in. So, and then you can then start building that as price starts going up. So by the time it's breaking up, then you're adding up here. Now, some people will be saying, yes, but then you've missed out on all that profit if you'd have just taken a 1% trade. Yes, that's true. But this is a technique for traders who, in real time, can see, look, I've got a setup here, but it's not 100% clear at this moment in time. So what I'll do is I'll put a smaller position size in, and then I'll build it as it starts to go. If it fails, and this is where people get it wrong and say, oh yeah, but you miss out. Yeah, I know, but if they roll over, then you lose less because you've only put a third in or a half in at that stage. You don't lose as much if you're wrong at that stage and gold's still got to do a larger retracement. So scaling in and edging into trades. So there's two elements: scaling or edging into trades, as I've just talked about here. Don't forget to you can put a smaller position size in first, and then start to build it as it starts going in your favor. I've already talked about adding to winning trades in the past anyway, but that still comes under the title of scaling in. So by the time that gold's coming up here in this example, you're adding in by this stage because you've got in, well, whether it was over here or over here, and so you're just adding at this stage to build that position up, and then you're fine anyway with your position over the longer run. So it's definitely a consideration. I'm not saying you have to edge in and dip your toe in the water on every single trade. No, not at all. It's just gold's a good example of a market whereby the context was starting, yes, it was quite it's been in a sideways range. Yes, that's bullish overall, but it does not mean, if I come out to a weekly time frame, that gold couldn't have. It's looking more likely it's breaking up, obviously, at the moment, but it's not to say that it couldn't have started to edge lower and do more of a pullback. So does that mean you just don't trade? Because a lot of people will say, oh, I don't want to put a full size position on, and they forget they can actually put a smaller position in, edge in, and then dip their toe in the water and then see how it goes. So it's a great, easy concept. People forget that they can actually split their trades up when it comes to trading. I do it all of the time. I'm splitting up trades. And then start to add as you go along. So just a little top tip there for Saturday. Have a lovely weekend. I'll see you next week.